Good morning, ladies and gentlemen. Welcome to the Central Coast Economic Forecast. I'm Bob Wacker. I am pleased to be back as your MC for today's forecast. We thank you very much for joining us. We believe we have a lot of good data for you today. You know, so much has changed since we last met at the Madonna Expo Center in early November of 2019. Not the least of which is that is the last day I shaved. So this is not a coronavirus beard. I like to think of this as my economic forecast beard. We left that night for a trip to Australia and New Zealand, and I haven't shaved since, happily. But first and foremost, we want to send our good wishes and hopes that you are healthy and that you and all of your loved ones are doing all the things that we all need to do to make sure that we stay safe and stay healthy in this pandemic time. Everything is different in 2020, and nonetheless, there's still a need for good data about our economy, what's happening in the world, what's happening in California, and what's happening in the United States. And so we have a different format this year to provide our community with what we think is sorely needed information in this time of uncertainty. This is the first in a three-part series. The other two will be held in the next couple months. The dates will be flashed on your screen, so please make a note of those so that you have those and will be ready to join us for those, all three of those events in September and November, as well as today. And today we are recording and digitally sharing today's program in the community. This is a first for the Central Coast Economic Forecast, and we hope and think it's a great service to our community. Now, the Central Coast Economic Forecast is produced by volunteers who have been hard at work, really very hard at work with the new format that we have this year. And leading the board of local leaders is the chair of the Central Coast Economic Forecast, Jeff Thoma, the vice president of Thoma Electric. So Jeff, we ask you to welcome the group as well.
Thank you, Bob, and welcome all, and thank you for attending our first installment of this year's 2020 Central Coast Economic Forecast. We're all set for a great program ahead today. This year, in the face of unprecedented times, our CCEF Board of Directors has worked hard to pivot and reformat the program to bring the community a series of virtual events aimed at providing timely and vital economic information. I'd like to thank our Board of Directors and our Operations Manager, Stephanie Bertu, who have put in many hours over the last few months to bring this series of events to you. I'd also like to thank Bob Wacker for being with us again today to MC the event. We're always grateful for his charm and quick wit. Support for the CCF is entirely dependent on funding from sponsors like yourselves. Please know that your sponsorship directly contributes to the economic strength and vitality of our community. As Bob mentioned, we're recording today's event and plan to share it with the community, which is a first for the CCEF. It's our hope that broadly distributing today's program will positively impact more businesses in San Luis Obispo County than ever before. On behalf of the board, I sincerely thank you for your support and your continued contributions to bringing economic data and analysis to our community at a time when it's desperately needed. In particular, I'd like to offer a special recognition to our 5 platinum sponsors: Amazon, AMF Media Group, Bank of America, Cal Poly Technology Park, and KSBY. We couldn't produce this series without your support. And with that, I'd like to hand it back to Bob to begin our program. On behalf of the CCEF board, please enjoy the show.
A couple of housekeeping items before we turn it over to our star presenter. First of all, we do have a chat box at the bottom of your screen. There's not a Q&A box, but the chat box works as the Q&A box, or at least the Q box. Chris will provide the A's later on. So if you have questions as Chris goes through his presentation, please use the chat box to ask your questions. We'll look at those and we'll leave about 15 minutes at the end to answer those questions for you. Also, you probably have been, as if you're anything like me and Jeff and Chris, on plenty of Zoom meetings over the last several months, but this is different. This is a Zoom webinar. So you see all the presenters here, but you can feel free to yell at me, or even better, yell at Chris. Eat your breakfast burrito with your mouth open. Nobody is going to hear or see whatever you do during this presentation today. Just use the chat box if you have questions. And we will have a survey. It'll be coming out via email after today's event. We ask that you fill it out in a timely manner while the ideas are fresh in your mind, or your impressions are fresh in your mind. Since this is a new format, we want to make sure that we do it as well as we can. So please respond to that survey. Now, onto the program. Chris Thornberg, as most of you know, is the founding principal of Beacon Economics. He's well acquainted with the Central Coast, or at least our wineries. We know that for sure. And since he was last here, Chris joined other prominent economists in contributing to the monthly Wall Street Journal Consensus Outlook Survey. He authored a substantial and critical analysis of the very complex PG&E bankruptcy plan, and we think he may have single-handedly driven up Zoom's stock price, which is up there pretty high, after delivering upward of 40 outlooks on the platform over the past 4 months. So without further ado, Chris, thanks for joining us. On to you.
Thank you very much, Bob, and good afternoon, good morning, everybody. It's a pleasure to be here. Certainly an interesting environment. Obviously, we found a lot of things over the last couple of months, not the least of which, while Zoom actually is a reasonably good platform to do speeches, it does, of course, lack the ability to choose your favorite room at the Banana Inn. So, as noted, we are doing a slightly different format this particular year. We are going to be doing multiple talks, and that's appropriate. You know, when I first started talking up in the Central Coast Economic Forecast, of course, we were in the midst of the Great Recession. And back then, we did quite a bit of work, again, to help people chart stuff out. But as time went on and the expansion continued and things were a little bit more stable, we backed off to about 1 year. But here we are yet again in the midst of a tremendous period of economic uncertainty. And I think it's definitely necessary to more often update where we are and where things are going. As the first of this three-part series, today I'm going to be focusing largely on the national situation. As we get further along, we'll get more and more into the local situation. But today, the big questions are about the track of the U.S. economy, since ultimately the track of the U.S. economy is going to determine what happens here in California and, of course, what happens along the Central Coast. So with that, let me go ahead and bring up my slides. There we go. Excellent. So let's go ahead and just get right into it. I'm going to back up a little bit and talk about my forecasts really from the start of this year, which I think in a lot of ways were a natural add-on to what I talked about last year when I was last time with you up in San Luis Obispo County. If you remember, of course, last year was a period also of uncertainty, and there were a lot of folks talking about the U.S. economy going into a recession by 2020. Now, mind you, what people were talking about last year was not the virus. Rather, they were talking about real estate meltdowns. They were talking about inflation and interest rates on the rise. They were talking about a Chinese trade war that was going to absolutely demolish U.S. manufacturing and, of course, hurt consumer spending quite sharply as well. Well, by the beginning of this year, I would say that I was on a bit of a misplaced victory tour. And what I mean by that is, you know, at the start of 2019, about 80% of economists who contributed to the Wall Street Journal Next Recession Survey said we were going to have a recession by the end of 2020. By February of this year, that number had dropped from 80% to 11%. And of course, I felt vindicated by my views last year about what I thought were the health of the overall economy. But in February, even as I presented this, I noted that the top risk was the emergence of the virus, first in China. And of course, in February, it has started to expand to other parts of the world. Clearly, we had a problem, but at that point in time, nobody truly understood just how profound an episode this was going to be. Now, where are we right now? Here it is, July 2020, multiple months after that happened. You've seen the numbers on a day-to-day basis, over 12 million cases globally, approaching 600,000 deaths. About 1/4 of the cases and the deaths are right here inside the United States. We know there's been an increase in the number of new cases to over 50,000 units per day, cases per day. Again, not good news from better numbers we were seeing a couple of months ago. We think if you sit down and do a reasonable projection right now, we're at about 135,000 deaths in the United States. We will probably end up at about 200,000 deaths from COVID-19 by the end of this particular year. Now, to put that in context, annually, there are about 3 million deaths in the United States. So this will be about a 5 to 7% increase in deaths, and obviously tragic for the families who've lost loved ones in the midst of this pandemic. But of course, what we're here to talk about is more the economic impact. And there's no doubt that this has been a pretty dramatic turn of events. We are in the midst of a recession, the first what you would consider to be pandemic-driven recession in modern history. We know that fear, along with health mandates, substantially slowed economic activity, particularly consumer spending. From the fourth quarter of last year to the second quarter of this year, we estimate about an 8% decline in real GDP. Now, again, context is king. How do you recognize that 8% number? Well, during the Great Recession, there was a 6% decline from peak to trough, real decline in GDP over 6 quarters, mind you. So it was a little longer, not quite as deep. And of course, at the moment, unemployment remains in double digits. The question is, where from here? And the debate, as it's been sort of ground out over the course of the last few months, has been the U or the V. And I realize there people are talking about, L's and square root signs and Nike swooshes, but whatever. It's a U versus V conversation. U meaning slow recovery, V meaning more rapid recovery. And the debate is still there right now. In fact, as we get into the data, what you're going to find out is the path of recovery is really the only question left, since all indications are that April was the bottom. That is to say, April was the worst month for overall economic activity. May has been significantly better than April, and June, yet again, better than May. But again, where from here? Well, there's two major drivers to that particular answer, that particular question, and we need to be careful to not conflate the two of those. The one driver is, where is the path of this particular virus going? We know there's been an increase in the number of new cases, but where from here? How far does this go? When do we finally get past this, where this is controlled to the point where we can start to resume what I would call normal behavior? The second part of the question is, how much damage has occurred to the economy as a result of the closures? And that's important as well, because if there's a lot of damage, that means the recovery will be slow, even if the virus is in fact pushed away. Now, again, when you hear all the U's and the V debates, too often economists confuse these two situations. How much of your slow recovery is driven by the fact that the virus is not going away versus how much is driven by the damage brought to the economy? What's what? What we're going to try to do today is separate a little bit of those, think of these two questions separately, and then, of course, give you some sense of what's going on. Now, if you've been reading the news or listening to the news or watching the news, whatever the case may be, you know that the consensus seems to be you. The negative headlines that we've seen over the past few months have been really tremendous. This has been consistently compared to a depression type situation, a Great Recession type situation, clearly an ugly, ugly situation by the consensus opinion. The OECD, the global economy is going to be feeling this for a long time to come. Worst downturn since the Great Depression, meaning worse than the Great Recession. Multiple years for the government to get back up and running. You're talking about financial market predictions. Carl Icahn, for example, said commercial real estate is going to, quote unquote, blow up. Again, lots of really negative projections about what's happening out there. But, what does this mean? Probably the best projection for us to consider this by is what the CBO recently pushed out, the Congressional Budget Office. And this is the output gap metric. If you will, 0 is our potential GDP. And of course, the orange bars represent how far from that potential GDP we are. And you can see how tremendous. They're talking about in 2020, the entire year, a 6% loss of GDP relative to what we should have been, and not getting back to normal levels of economic production really for almost 8 years. In other words, what they're talking about here is a shock to the economy that is about as bad in an accumulated fashion as what happened during the Great Recession. That's scary stuff. We all remember how painful it was in the years after while the economy tried to get going again. And if you look at this, you go, wow, this is maybe it's time for me to retire, as the case may be. But as always, take a step back, because the other thing to remember is the conversation last year. You remember in January of last year, the markets were down 20%. February, 80% of economists said we were going to have a recession for all the reasons we already discussed. The point here is very simple. Unfortunately, in this day and age, any conversation about the economy immediately devolves to hysteria. It's always been the case, whether we're talking about the long run and how terrible the expansion has been, to the short run and how certain everybody was that we're going to have another recession. In fact, if you wanted to sort of talk about what my speeches have been up there in the Central Coast over the last few years, it's been this: it's not that bad. It's not that bad. It's not that bad. And guess what? Yes, the longest expansion in U.S. economic history is over. Yes, we're in the midst of the first virus recession in modern U.S. economic history. And guess what? It's not that bad. It's not that bad. Like, as typical over the last decade, this has simply devolved to hysteria. What's the reality of the situation, and why have we gone to hysteria? Well, at a very top level, we understand why everybody's gone there. Because if you look at the unemployment rate, right, it's all by itself, it's very scary. Very quickly, the unemployment rate, depending on how you count it, got up to about 15%. The highest unemployment's been in the post-World War II period is 11%. And history shows us something very specific. It tells us that when unemployment goes up, it takes a long time to come down. Ergo, since unemployment's higher than it's been since the post-World War II period, this must be a long, painful recovery. Yet, I would say that while maybe this is the driver of all these negative forecasts, there's a lot of assumptions built in here, assumptions, candidly, that aren't true. Right off the bat, can you just look at unemployment and compare it to the past business cycles we've been through? Because remember, when you forecast, inherently what you're doing is saying the past is similar to today. The kind of patterns we saw in past recessions are going to look like this recession. And that is how you draw what's going to happen next. But it isn't necessarily the case. You know, in a very real sense, the models that economists use, the models that we use inside Beacon Economics, those don't necessarily work if this business cycle is not like past business cycles. And I will tell you, that's exactly the case. In fact, right from the get-go, while we've acknowledged the seriousness of this particular pandemic, we have not bought into the U theory. Yes, we see the scary numbers. We understand they're shocking. We understand that when you put these numbers into a traditional VIR model, it gives you a scary, long downturn. But again, that depends on the past business cycles, particularly the Great Recession, being a good metaphor for what's happening right now. And even here, even in the midst of the scary graph, you can already see why that metaphor is starting to break down. Look at past business cycles. Look where the peak of unemployment occurs. It occurs at the end of the recession, when things are actually over. The reason for that is employment is what economists call a lagging indicator. It happens after everything else. And it happens after everything else because businesses always lay people off as a last case decision. You don't lay your people off unless you absolutely have to. It's incredibly expensive. It's expensive for severance. It's expensive for unemployment. It's expensive because you're pushing years of experience out the door. It's expensive because it's crushing to the morale of your existing employees. You don't do it if you don't have to. So it lags. This time, it hasn't lagged. In fact, this time, it's a leading indicator. And that means the world. It means it is not the standard metric that we're typically used to. And indeed, the idea that this is going to be worse than the Great Recession, that this is on par with the Depression type scenario, no, not at all. Because those downturns, the Depression and the Recession, had a very specific cause. And that was the collapse of a massive financial bubble. You know, it's interesting. If you think about the Great Recession and where we were when I first started doing my talks in Central Coast, up at the Central Coast Economic Forecast, we were in the midst of a very painful downturn. And that downturn didn't just come out of nowhere. It wasn't a big surprise the way this was. In fact, when I started calling recession in 2006, when I first started Beacon Economics, it wasn't because I saw something magical. It wasn't because I was projecting ahead. In fact, what I was doing was acknowledging what was already happening. Look, between 2001 and 2007, this nation went on a borrowing binge like we've never seen. $15 trillion of debt, mostly subprime debt, was poured into the economy in one of the greatest financial frauds in the history of the globe. And that, of course, has to do with the asset-backed security model that Wall Street was using to convince investors that, no, you really can give a bunch of people a bunch of money they should never get and turn it into gold-plated securities. You can't. Now, the problem here had to do with the fact that $15 trillion caused the U.S. economy to grow in ways that were simply not sustainable. For example, housing. Housing exploded in terms of pricing. The borrowing that went on was crazy. And of course, builders responded to that by vastly overbuilding the housing stock. But it wasn't just subprime mortgages in the housing market. It was also subprime auto loans and subprime credit card loans. And the fact that people thought that, wow, I can borrow money forever for nothing. And as a result of that, you saw savings rates drop to the lowest they've ever been in the United States. You saw the U.S. open a huge trade deficit, and consumer spending was clearly out of whack at a higher share of GDP we've ever seen. In 2006, when the U.S. economy may have felt healthy in terms of growth, the reality was it was rotten to the core, and things were already starting to fall apart. The turn in the financial markets happened in 2006. The collapse of housing happened in 2007, and it finally accumulated with the Great Recession starting at the beginning of 2008. And it was a nasty run, as we should have expected. Because, you know, there was a wonderful book written a couple of years later. This time is different. Reinhardt and Rogoff, two of the few macroeconomists in the world I have a lot of respect for. Most of these guys are in La La Land, but these guys are absolutely brilliant. And they go through and they detail the history of financial bubbles. And one of the very important things they say at the very beginning of the book is this: you have to pay attention to this, because the worst recessions always follow financial bubbles, always, because the economy doesn't just contract. It has to completely restructure itself. You have consumers that went from overspending to having to rebuild their balance sheets. You have debt markets that are absolutely decimated, and of course leads to the inability of credit markets to fund more economic growth. It's a very, very tough situation. This is not that situation. Nothing about what's happening today in any way, shape, or form reflects what happened during the Great Recession. In fact, think about just what's happening today. Back then, when that Great Reset, when that giant credit bubble collapsed, it left the U.S. in a horrible position where it had massive imbalances that it had to heal from. This time around, the shock to the system is not some permanent shock, but a very temporary one closed by fear and public health mandates, preventing certain parts of the economy from operating. But the way to think about this is, we get this. All these people couldn't go to work because of the fact that people couldn't spend money, because they were afraid, because public health mandates said you couldn't do what you wanted to do. But imagine this just for a second. Imagine 3 weeks after this virus had hit the United States, some genius had come up with a cure. What would have happened? Well, we would have reopened the economy, the virus would have went away, and I think we all would agree within a week, everything would have gone back to normal. Nothing would have changed. And that's the key. The key here to understand is that the damage to the economy, the damage that will ultimately determine how rapid a recovery we have, comes from what is happening now in the midst of the closures, rather than what we saw at the beginning, which was, of course, all these people being pushed into a temporary layoff situation as a result of the short-run closures. And when you think about it that way, you realize that, wow, okay, now I get it. The economy's being hit. You know, people are losing income. Businesses are losing revenues. There's supply chain effects. But how much of that actually is going to impact the economy, we don't know yet. It's still an unknown question. And that's why all these people coming out and saying this is going to be worse than the Great Recession, they're leaping to conclusions without really having any basis. Look, it could be a U if the damage is so profound, if this virus won't go away. A U makes sense. However, if the virus actually does start fading away, or if people just learn to live with it, businesses learn to live with it, equivalently, if the economy isn't all that damaged, the economy should come back relatively rapidly over the course of the next couple of quarters. Of course, if the virus is beaten completely, if there's no damage at all, we could actually have a natural disaster type scenario. And the thing about natural disasters, whether it's the Northridge quake in LA or whether it's Hurricane Andrew hitting the Miami-Dade region, under those sort of circumstances, what you see is an economy that, is temporarily put into a lull mode or stall. It's just not allowed to operate. But then again, as soon as things reopen, as soon as you clean up, the economy explodes back. It grows tremendously rapidly as people basically catch up on where they were prior to the disaster actually hitting before you get back to normal levels. We don't know. So here's another way of thinking about it. And it goes back to this idea that you can't just look at unemployment. Look, when we first got the April numbers, everybody was amazed. We had 22.5 million unemployed people in the United States. We have never had in the last 80 years this many unemployed people in the United States, all of a sudden, right out of the blue. Yet, why were they unemployed? During the Great Recession, you had millions of people who lost their jobs in finance and retail, in construction, real estate. And by the way, they lost those jobs permanently. Those jobs were never going to come back. This time around, 17 million people were immediately thrust into unemployment. And all 17 million of those people said, I didn't lose my job. I'm simply on temporary layoff. And every time the newspapers say, oh, the US lost 20 million jobs, we lost 18 million jobs. We didn't lose these jobs. These jobs are there. People just aren't able to go to them. And indeed, take a look at the right-hand side. This is unemployment rate by reason for unemployment. And I want to distinguish two types of people out there, the permanent losses and the temporary losses. Temporary losses shot up to 12% of the labor force. By the way, they've already dropped back to 6%. That was the initial surge of the virus. That was the initial surge of businesses closing down till they figured out what they could do, how they could do it. The number you need to pay attention to is the permanent losses. And those are growing. Look, we know all these temporary layoffs are going, some of these temporary layoffs are going to turn into permanent job losses. That's the number you want to watch. That's the number that tells you how profound the damage is going to be. By the way, that number right now has only risen to a little bit above 2%. It's still below where it was during the incredibly mild tech recession. And of course, nowhere near the 5.5% it was during the Great Recession. That's the number to pay attention to. And what it says is right now, believe it or not, this is still a mild recession. So, will it stay mild? How fast will we bounce back? It depends on 5 questions. Forget your models. The models don't work. 5 questions. How healthy was the economy prior to the pandemic? How much of the economy has been hurt? What has the government done to intervene? How long will pandemic impact economic activity? And will there be a major shift in post-pandemic spending patterns? You answer these 5 questions and you can get a result. Not a nice numerical result, which I know we all want, but unfortunately, again, these models just don't work in these kind of circumstances. What's it going to be? What's it going to look like? Well, let's go through these questions really quick. How healthy? Well, listen, if you've been to the last Central Coast Economic Forecast, if you've been to any of them in the last 5 years, you know the answer here is the economy is very healthy. Yeah, growth isn't all that exciting, but growth versus fundamental health are 2 different things. Fundamental health has to do with just the structural stability of the economy. In 2006, overall growth was good, but the structural health of the economy was awful. In 2019, growth wasn't all that good, but structural health was great. It's an important distinction. That's why we had over 2% growth. Yes, job growth has slowed down, but that's because unemployment rate's been at a 50-year low. As I've noted over the last couple of years, the biggest problem in the United States has not been a weak economy, but a lack of workers. We have been running for 2.5 years with more job openings in the US than there have been people looking for work. We live in an era of labor shortages. Now, some people aren't going to get their jobs back. They will re-enter the tightest labor market we've seen really again in 50 or 60 years. Relatively good news from a recovery standpoint. And it isn't just a tight labor market. That tight labor market has been leading to wage increases, very good wage increases. In fact, over the past couple of years, average and median wage increases have been a little bit better than they were the last expansion. A household savings rate, prior to the Great Recession, they had dropped down to about 2.5%. Prior to the pandemic, they'd actually gone up to 8%, the highest we'd seen in 30 years. Everybody keeps talking about debt problems and massive issues in debt markets. Why? Well, it happened during the Great Recession. That's totally irrelevant. Remember, the Great Recession occurred because of the massive debt bubble that preceded it. There has been no debt bubble. In fact, regulations, along with some consumer fear, meant that over the last decade, we've seen very, very constrained debt markets. And it really has put us in a very good position to weather a storm like this. On the right-hand side, the financial obligations ratio, the share of income going to debt obligations. Prior to the Great Recession, highest it's ever been. Prior to the pandemic, lowest it's ever been. On the left-hand side, it's kind of a breakdown of debt income, debt payments to family income. And here I'm breaking it down by level of income. This comes from the Survey of Consumer Finance. Again, very good information. What do you see here? Well, again, overall, median debt to income ratios lower in 2016 than 2007. By the way, also lower than they were in 1998. Lower for high income families by quite a bit. Also significantly lower for low income families. We just don't have as much debt. We're not as debt sort of dependent today as we were prior to the Great Recession. And that, again, helps us weather the storm at some level. Now, you've probably all seen this headline over the last couple of months. It got rolled out yet again. This idea that, oh, that sounds good, but really, I hear 65% of Americans can't even afford $400 for an emergency expense. You know, this is the kind of stuff that makes me a little crazy, because I can't begin to tell you the number of economists have gone out of their way to completely debunk this preposterous assertion. It came out of a busted survey. Even the people who did the survey acknowledged it was a flawed statistic. Why does it keep coming up? Because it feeds a narrative about a U.S. in decline, a narrative, by the way, that is simply false. Put this to one side, it isn't true. We're not all on the brink of financial disaster. We're just not. I heard Mark Zandi, an economist who I used to have respect for, come out at the beginning of this thing and say, quote unquote, 15% of homeowners will be foreclosed on if this thing continues into June or July. By the way, it's continued into June or July. 15%? Why? To be clear, 15%, that's the share of homeowners who lost their homes during the Great Recession. By the way, they didn't lose their homes because of the Great Recession. They lost their homes because of the subprime bubble. A lot of people borrowed a lot of money to buy homes they never should have bought at prices they never should have bought them at. And when that collapsed, they lost those homes. That has nothing to do with the recession. In fact, if anything, it was part of the cause of the Great Recession. This time around, housing markets look great. What bubble? Over the past couple of years, home prices have been running a little less than 5% nationally. In fact, last year it cooled off. Prior to the Great Recession, record share of units for sale for rent in the U.S. economy. Prior to the pandemic, record low. Not a housing market that's going to collapse. And the credit markets have been super tight because of Dodd-Frank's. And the other thing, for all those folks screaming Armageddon in the financial markets, look on the right-hand side. Financial market problems don't happen overnight. It takes a year to foreclose on people. You're making a lot of assumptions when you start talking about 15% of homeowners getting foreclosed on. And to be clear, again, let's look at the Great Recession. The problems in financial markets didn't show up in 2008. They showed up in 2006. Remember those predictions of a recession coming? Again, I didn't pull that prediction out of my hat. It was in the data already. You already saw increases in delinquencies. Of course, they exploded when the recession actually hit. But again, where are we right now? Credit markets look great. No major problems out there. Now, how deep is the recession? How much the economy is actually being influenced? Again, a lot of scary numbers. And those scary numbers mesh, I think, with our personal experience. I had the first couple weeks of this, I had a bizarre experience. I was fortunate that our daycare didn't actually shut down. As you know, I have little kids. And one of the things about that, is I would pick them up and I'd be in the 405 at 4 o'clock in the afternoon, which means I should be driving at 2 miles an hour if I'm moving at all. And I'm going 85. And that's just weird. That's like Armageddon weird, right? And we all have that impression. And then you see these numbers. Looks like we're going to see probably a negative 30% growth rate in the second quarter of the year. And you go, 30%? Again, take a step back. How many people on the roads isn't a good reflection of what GDP is doing? Yeah, it feels like it, but it's not. And these numbers we keep tossing around, negative 30%, that's annualized. That means negative 7.5% in the second quarter. That means, guess what? 90% of the economy is still operating. 90% of consumer activity is still operating, or overall economic activity is still operating. It isn't quite that deep. And as already noted, not only is it not quite that deep, but April was the bottom. You take a look at the numbers. This is the ISM for manufacturing. Huge down, already bouncing back strongly. Same thing for services coming into June. Big bounce back in the ISM for service spending. Here's some data from Goldman Sachs on a current activity indicator. And you can see in April, they tracked about a 25% decline in economic activity. That's enormous. But in May and June, it had bounced back very sharply. People got a better sense of what was going on. Businesses learned how to mitigate. We all started to figure out how to operate in a COVID world. So we're already past the bottom. If anybody is talking about this economy not being able to rebound at all, well, they were wrong completely. I mean, there were people, seriously, at the beginning of this thing, who were projecting more negative growth in the third quarter. Ridiculous. The economy has already come rip-roaring back, very simply. And the reason this is all important is because we have, every time you talk about someone talking about this weak recovery, what do they bring up? All the people falling behind, all the businesses falling behind. Businesses are falling behind on rent. People are falling behind their debt payments. These people aren't going to be able to spend. It's going to be a horrible second half of the year. I get that. There are people and businesses falling behind. But there's also someone else falling behind, which is people making money but not able to spend it. Take a look at this data. Overall earned income declined from February to May by about $1.3 trillion. Outlays declined by 1.8. So spending declined by more than incomes did, which means, by the way, there's a buildup of money in the system. That is to say, pent-up demand is larger than constrained demand. And I haven't even talked about government stimulus yet, which is the next thing. Now, government came in like nobody's business. And again, the differences between the Great Recession and now are profound. During the Great Recession, fiscal stimulus, it was too late, too little, and really stupid. And that was, of course, driven by the election. This time, it's too fast, too much, and really stupid. And it is also driven by an election. Politics in election years are weird. And this year, yet again, incredibly partisan. Both parties are out there because they understand there's a big thing coming down the pike, and they want to be seen as the saviors. And what have they done? They already passed a $2.5 trillion stimulus act. Overall stimulus was nowhere near this during the Great Recession, which candidly was a far more profound circumstance. This time, way more stimulus, and they're already talking about a second round. Now, some of this stuff I'm completely comfortable with, right? Expansion unemployment insurance program, fantastic. The PPP loans that went to truly hurt small businesses, I like it. But then we start getting weird. $1,200 for every American? Well, why would you do that? I mean, look, not every American lost their job. Not every American lost income. By the way, the biggest problem for most Americans is they can't spend money. You're giving $1,200 to a family who has a problem in as much as they're not allowed to spend money? That's not helping the economy. That's called buying an election. And then, of course, we had the PPP loans that didn't go to restaurants, that didn't go to hair salons. Where did they go? They went to law firms. They went to private equity-backed firms. I mean, the law firms, accounting firms, what was this about? The companies that got these PPP loans is unbelievable. Again, you're just handing money out. with no semblance of whether or not this is actually helping fill some hole left in the economy by this. Now, again, some of it was good. Unemployment, actually some of the local government supports, I get all this. But, look, however you want to look at it, we've never seen so much stimulus. And it wasn't just the federal government. The Fed, fuel QE efforts, rate cuts like crazy. IRS says you pay your taxes late. Local governments putting moratoriums on evictions. Landlords are just going out of the way to give people deferrals. Everybody's getting involved to help businesses and people make it through these few couple months. Now, again, how over the top is this? And remember, they're talking about a second stimulus plan. Now, remember, these are the numbers from before. About 1.3 trillion in lost income. That's annualized over 3 months. So divided by 4 to get it in actual monthly terms. We saw about 1.8 trillion in loss and declines in spending. The government put in $2 trillion of stimulus. So to be clear, for every dollar of lost income, the federal government has put back $1.50 in stimulus. What? $1.50 in stimulus for every dollar. And take a look what that means. You can't spend, you're getting tons of money. Savings rates have gone up by $2.7 trillion. The highest savings rates have ever been in the United States was 13.7%. The savings rate in April was 33%. We've never seen anything like it. The FDIC is reporting that bank balances have risen faster than they have ever seen. People are sitting on tons of cash. And to get back to the idea of people falling behind versus pent-up demand, we have wonderful high-frequency data if you're able to pay the credit card companies for it. This is from Opportunity Insight. They do some great work. It's a billionaire-funded think tank run by a really bright economist. And this is credit card data taking us through June 10th. Low-income spending has only dropped by 4%. That's it. So those low-income families, many of them who've lost jobs, they've actually been doing okay. They're hanging in there because of all the money, all the support, all the unemployment, everything else. The real decline in spending is for high-income families who, by the way, aren't suffering. They have wealth. They have money sitting in the bank. Their problem is they haven't been able to take that trip to the Caribbean. They've been forced to go, I don't know, Solano Beach or something horrible like that. That's where Bob is right now. Anyway, the point here, of course, is yet again, the pent-up demand is really in high-income earners. That's where all the declines are. That says as soon as this virus gets out of the way, this economy is going to explode. We aren't falling behind. We aren't getting hurt. In fact, my biggest worry for the end of this year has nothing to do with the virus and everything to do with the federal budget deficit. We entered this year, we were going to borrow $1 trillion. $1 trillion in the 11th year of the expansion, the fundamentally healthiest economy in 30 years, $1 trillion in borrowing. All by itself, that was unreasonable. Now we have $2.5 trillion in stimulus combined with probably $0.5 trillion in lost revenue. You're talking $4 trillion in borrowing this year. We entered this year 10 years away from a fiscal crisis driven by Social Security and Medicare with $50,000 in debt for every man, woman, and child. We're going to borrow $12,000 this year alone. We're going to see debt go through the roof. We're going to go in this year from 100% debt to GDP ratio, this is gross, not net, to 128% in 1 year. You're going to see $4 trillion in borrowing by the federal government all by itself this particular year. Look at overall total borrowing. This is increase in outstanding debt in the U.S. It's been running $3 trillion a year, $4 trillion in federal borrowing alone. I'm amazed we are seriously talking about a second stimulus plan. This is not free money. Our children have to pay this back. Our grandchildren have to pay this back. It's like we don't care. We just don't care. We're so obsessed with it right now. We're so obsessed with our own sense of misery, whether it's real or not, that we just completely forgotten the future. And that is a travesty. Now, how long? Now, that's the last big thing. And no, sorry, this is number 4, not number 5. Look, I get it. The number of new cases is now 50,000 per day. But guys, this isn't a second wave. For anybody who thinks this is a second wave, it's not. A second wave is when a place like New York or New Jersey or Italy start to see a lot more cases. This is simply the expansion of this virus into new places. Here's what we learned. You're not going to contain this thing. It's as simple as that. It's going to get into every corner of this planet eventually. we're not helping ourselves in some ways by constantly trying to stop it. It's proven itself to be very, very tenacious. But it's out there again. We know that. We know new places like Texas, Florida, they're all getting hit. The Southeast, here in California, yet again, another expansion. The government's talking about reclosing down. Should they? That's a huge question. Now, to be clear, there all seems to be this very simple metric. Government controls the spread of this virus. Unfortunately, the data there does not support that. In fact, if anything, the data says something completely different. It's consumer fear that drives the spread of this virus, not government mandates. Mandates may play some modest role in that, but it's really about consumer behavior. And closing down a bunch of the economy again may do very little, except for candidly making a bad situation worse. It's not about that. It's really not about that. Q3, we continue to see reopening of business. I'll get back to that in a second. The one big wild card is a true second wave, which I don't think is going to happen, but I'll come back to that in just a second. Let's just go through this. First of all, we know the number of new cases is rising, getting close to 200,000 cases per year. Remember, guys, this is all driven by, if you will, getting into new places like Italy, Spain down. Here in the United States, very similar sort of picture. New deaths, of course, continues to fall. It's labelized just a little bit. And again, sorry, I got the animation here screwed up. I wanted you to see that graph behind here. But in terms of thinking about the second wave, I don't know if you saw this news yesterday. According to some places in New York, the overall number of people with antibodies in New York is running right now about 68%. Number of deaths, again, continues to fall. Again, that says that some of this is testing. It's getting into parts of the population we're testing before. It also means people who need to be careful, being more careful. It says yet again that it's not quite as bad as it was last time around. But again, we're still a little bit wait and see mode. Getting into the whole idea of where this thing's occurring, how bad it is, should we shut the economy down? Everybody keeps talking. Every time I pick up the paper, I hear about how Sweden has done so terrible. Oh, Sweden did a terrible thing, not shutting their economy down. Have they? Have they really? Their economy has not contracted. It contracted a little bit, but not as much as other places. And let's take a look at all overall deaths in Sweden compared to Italy or the United Kingdom or Belgium. Yes, they're worse off than Norway is, but they're still better off than the United Kingdom and Italy. It isn't clear that, of course, Sweden is a failure. In fact, if many things, the evidence would suggest that maybe Sweden was taking the right course on this. And if you really want to think about that, think about Japan, which never closed their economy and yet has no cases at all. The spread of this disease is really driven by personal behavior, not by government mandates necessarily. And that even gets back to why things slowed down. Take a look at the data here. This is, again, that weekly data on consumer spending. The big declines in consumer spending, which led, of course, to the actual slaughter number of new cases, occurred in the second half of March when this was scary and new and no one knew what it meant. By the way, the mandates didn't start to the beginning of April. Behavior leaped ahead. And again, the mandate started being lifted in mid-May, but it was really people saying, I'm tired of staying at home, going out and partying, that caused the resurgence that we're seeing going on right now. And what's interesting about this, yet again, let's take a look at South Carolina and Florida, two places that have seen new outbreaks. And look what's not happening. You're not seeing the same collapse in spending you saw the first time around. So again, mandates, I don't know if they're doing anything. This really is about public health. It's about people wearing their masks. It's about being careful, not about the government getting involved. Government should get involved in helping people do the right thing, not telling restaurants they can't open. It's not really helping the situation, as the case may be. Where you really want to put your effort is protecting those at risk. Because again, while the few exceptions are out there in the news to make us all really worry about this is primarily an issue for people who are older. It's as simple as that. Most of the deaths have been 55 up, 65, 70% of deaths are 80% of deaths, are over people over 65. It's huge. It's basically all there, or 55, all in that older category. And those, of course, who have some health compromised conditions. Are we really helping ourselves by trying to stop the virus, which doesn't seem like it wants to be stopped, by simply shutting things down when it doesn't necessarily protect those who need to be protecting? There's a lot of uncomfortable questions here that have to be asked. clearly we need to get this thing under control. But I still think that mandates aren't really the way to do these things. Last but not least, the last question, government, consumer behavior, business behavior. Will things change substantially? Will we see a collapse in office demand? Will people never go to ball games again? We've heard all this kind of stuff as well. And I will go here and just say, look, no, this isn't a new normal. You know what's funny is everybody keeps talking about epidemics and people got to be too afraid to do anything. I'm like, really? Epidemics are new normals? I mean, everybody knows that Shakespeare wrote King Lear while he was locked away, hiding from the plague that was ripping through London. And by the way, when the plague was gone, he reopened the Globe Theater and people flocked in to see King Lear. In other words, this is, again, not a new normal. This has been with us for a very long time. And you're already seeing a circumstance by which people are just getting used to it. And that's the key here. People are getting used to it. Now, we're not going to get back to normal levels of economic activity while the virus is still down. But then again, the idea that we're going to collapse into depression because of it, particularly when businesses have learned how to mitigate, when consumers are not as afraid as they used to be, particularly younger ones, doesn't make any sense. This thing will be a weight on the economy while it still exists. And when that weight goes away, the economy is going to get back to normal quickly. 5 big questions. How healthy? Very healthy. How much of the economy has been hurt? Not all that much. What has the government done to intervene? Vastly too much. How long will the pandemic impact economic activity? Well, even with the increasing number of cases, it really doesn't seem to be having all that much of an influence. A little bit of a slowdown, but as long as the number of new cases yet again starts to go down again, as I expect it will over the course of the third quarter, again, I expect it to come back relatively quickly. And no, I don't expect a major shift in post-pandemic spending patterns. None of this says U. It all says V. And the only question is how fast of a V it is, which will be determined largely by how fast this virus works its way through the system. So, wrap it up. It ain't good. This is a recession, but it isn't that bad either. The V is the only logical outcome. Those talking about multiple year recoveries are basing it on an analysis that makes no sense because they're comparing this to a collapse of a financial bubble. It's not. The speed of this recovery is clearly really largely dictated by how rapidly we get control of this virus. So overall, first half of this year, about an 8.5% decline in GDP. We expect most of that to come back in the second half of the year. We expect unemployment to be well below 7% by the end of the year. Yes, there'll be some moderate upticks in debt distress, but no collapse in the financial markets because financial markets are in pretty good shape. Yeah, the stock market's been all over the map, but what else is new? Real estate values, not going to happen. The places you're going to see problems in our economy are places that already had a problem. Retail, restaurants in particular. Look, retail, we know the issue there. That, of course, have too much retail. They're competing with the internet. They're not going to come out of this hole because they went into it in a profoundly weak position. Restaurants, there were too many of them. And yeah, some of them aren't suddenly going to come back. This is simply pushing forward a problem. And last but not least, tourism, particularly tourism related to, say, big conferences and events, that will lag as well, mainly because it takes a year to get these things off the ground and no one's going to plan them until they have some sense of the future. But these are the only parts of the economy that are really going to get hit. And candidly, these don't represent that big a part of the economy. And if you took all restaurant, retail, and tourism and add them together, you're talking less than 5% of GDP. So wild cards, second round of outbreaks, real second rounds, getting back into regions that have already had it. Now, as I already noted, I don't think this is the case. If you look at some of the antibody tests coming out of New York, in some places in New York, 70% of people have antibodies. The CDC is saying 10 times as many people have been exposed to this virus that have actually been tested positive. This all says it's already pretty deep into our population, and but for some major mutation of the virus, which isn't common with coronaviruses, you're not going to see a second wave of this thing. This really is a one-time shot. Global situation, obviously, different parts of the globe are experiencing this on different levels, and that's going to continue to cause turmoil in global supply chains. Financial markets are trying to create their own crisis on their own just by over panicking. Travel, yet again, when does that get up and running? And of course, the $4 trillion in government spending by the end of the year. But for me, the true issue, the true problem, as always, miserableism. This constant need to make everything worse than it actually is. This has led us to, yet again, indulge ourselves in bad policy. Too much government support, talking about the end of the world and forgetting about the long run. We have across California, local governments putting preposterous local restrictions into place that will hurt the ability for the state to get housing when it still desperately needs housing. We've completely forgotten about the long run. We're so obsessed with the right now that we're allowing ourselves to make a lot of really bad decisions. And we shouldn't do this. So take a step back, recognize that the screaming hysterics you're seeing in the day-to-day news don't reflect an analytical assessment of what's going on. There's little doubt that this is a tragedy. I mean, we're going to have close to 200,000 deaths. A lot of families are going to lose loved ones, and that's sad. But in terms of the economy, we're going to get back to normal pretty quick on this. We just are. The fundamentals all say that's what's going to happen. So I'll wrap up there. I talked vastly too long. I appreciate the benevolence of Bob not to cut me off at the pass there while I was on a roll. I'm sure we're going to have a few questions as the case may be. So let me go ahead and stop my screen share and we'll get right to it.
All right. Thank you, Chris. We do have just a few questions, and we have just a few minutes, so that works out well. And I think a lot of it is that your treatment was very exhaustive and answered a lot of questions as we went through. One we have is that you mentioned all the stimulus that's happened and so on, and with an economy of people who are flush with cash. Is it going to affect risk asset prices? So you talked about the stock market, real estate. That money has to go somewhere. And it's, interest rates obviously don't offer a lot.
Yeah. Well, to your point, go back to the housing market conversation, right? There's not a lot of sales. They've slowed down a bit. Inventory's tightened up. Not a lot of people want to move right now. Yet, anecdotally, the few units that are out there the bids are coming in hot and heavy. Anecdote, I had a friend in Vegas selling a house and just sold it a week ago. Put it on the market for $475, 12 offers, final offer $525. Now, again, I'm not saying every circumstance is like this, but what you see out there is a lot of people with a lot of cash, and they're trying to put it someplace. You even saw a couple crazy rallies in the stock market. And a lot of people say it was driven by retail people with just cash and nothing to do with it. So I absolutely agree with that. That money is pouring into these markets. It's pouring into banks. There's a lot of cash out there right now, and it's going to help keep financial markets stable. If anything, maybe you want to worry about the emergence of another bubble, but that's hasn't happened yet.
Okay. One of the things you mentioned, we were talking about it earlier with Jeff's business, with mine, with yours, is all the people working from home, which may or may not be an extended factor going along. But do you see that as something that may extend, and does it have an effect on both commercial real estate and on residential real estate if people are going to be spending more time there?
Right. Yeah, that's a great question. Now, different kinds of commercial real estate, right? For example, retail, we already knew had problems, and retail is going to get hammered by this. There's no doubt about it. I mean, you look at the big bankruptcies, Neiman Marcus, J.C. Penney's, who are, again, corporations already on the brink, got to be closing down shops. Retail is going to get hit. Industrial is a mixed bag, right? We know that, boy, if you're involved in internet sales, you're doing great. You don't have enough space. If you're involved in global trade, you got an empty warehouse right now. So mixed bag. Office space, of course, is stable. But the question to your point is, are people going to start abandoning offices for a work from home type model? I don't think so. Look, I think we've all learned, when I say all, folks who manage other folks, those who are management have realized that maybe letting people work from home once in a while isn't all that bad. We've realized that you can be effective. People can do this. And boy, letting your people, particularly people who've proven they could work from home through this cycle, work from home a couple of days a week, let them not have to do the commute. It may be a really, really good plan, right? However, we also learned something else, which is you can't train people in remotely. You don't have those random idea generating, conference meetings, conference room meetings, where people are eating lunch or whatever. The kind of spontaneous interaction, that human connection, is not there. It's just not. And so while it can be done once in a while, I think yet again, by myself, my own personal experience is we're not going to close our office, not a chance. Sure, we're going to let some people work from home, but we're not going to close our office. People have to be there sometime, as simple as that. Maybe a little bit of diminishment in office demand, but not enough for what I would call to turn the market completely.
Okay. Thank you. And I'm afraid we do have some other questions, but we've run out of time, and we will send those.
We have 2 more talks to give.
Address them in the next one. Yeah.
Yeah.
With that, we do particularly thank you for joining us today. We thank our sponsors, particularly without whom this event, doing it this way or anyway, would not be possible. Please remember to fill out your survey when you receive it later, I think probably today. We will be sending the recording next week to you, and you can do with that what you will if you want to use it for your customers, clients, etc., and your team. Remember that the next webinar in this series will be Friday, September 18th at 10 a.m. So please mark that on your calendar. Make sure you put that on your calendar. We ask you to like us on Facebook at Central Coast Economic Forecast Project. And until then, until we see you in September, please stay well, be safe. And as I used to say on my old favorite show, Hill Street Blues, let's be careful out there. Till then, we'll see you next time. Thanks for joining us.